Welcome everybody to another business barbershop podcast. I forgot where I was at for a minute, which
Forgot
which
your name
video,
today?
which video I was making. I'm Chris,
I'm Keen.
and we are here to talk about our real estate deal, amongst other
Yeah.
things.
Yeah.
So I'm gonna, per usual, let Keen kick it off,
Yeah.
and we'll just go wherever this thing goes.
Yeah. We talked a little bit about like sectors, right? It's funny because I was talking to my friend Debbie last night, who's more like a friend of a friend. She's like really, she's good friends with my wife. I know her, I've met her a couple of times as work trips. When I was telling her last night, sums up a little bit what we're talking about, which is there can be a margin, like there's a different asset classes in real estate at different times go through different um, motivations and desirability. And that's technically happening right now. Like a bunch of people are trying to figure out how to do office conversions because office space is getting annihilated.
Yep.
So, one of the obvious things is try to find some other purpose other than office and see if you can convert it for a discount. There was people who did that during COVID with hotels. Remember, hotels were getting annihilated because no one was traveling. So some people did like hotels to apartment conversions. Um, I have always been obviously a condo converter, right? Um,
Yes.
which aligns with today's ADU world because you're basically taking houses and ADUs, turning them into condos. Um, and uh, and there was a moment um, when multifamily, when I'll explain kind of what happened in the market when rates first went up. Um, a lot of people propped up the multifamily space, especially in the 2 to 4 unit multifamily space. The reason why is because the general um, rule when it comes to like there's some like broad stroke concepts that gets laid upon things, right? And the nuances is where sometimes real value can be met, right? So what I mean by that is that in general, it's easier to buy real estate when rates are lower. In general, usually your cap rate is close to your interest rate on what you buy, right? There's all these like general like broad stroke rules about investing. And one of those rules is that in a inflationary high rate space, which is what we've been in for the last, 2.5, 3 years, residential multifamily, especially the products that you can get normal 30-year fixed loans on, which are like a 2 to 4 unit multifamily, are considered a good hedge against inflation. The idea of it is if inflation goes up, housing's one of the inflationary things. So if you get multifamily, especially if it's before rates went up, or if you're putting enough money down, then if the asset holds most of its value during that time, if it does drop a little bit with inflation, the adjustments are usually smaller, and that inflation can drive up the rent rates, which then of course makes the asset worth more, which then helps like make it a good curve. Like, oh look, I had to buy it on a higher rate. Yes, but in a high inflationary market, that's going to push up rents, which means it'll eventually catch up to it. And then also in time in the future, you can refinance and get lower rates. But inflation keeps pushing up the rents, which makes it a good hedge against inflation. In case that you wanted some of that. So that's a broad stroke rule. The
Yep.
problem with that broad stroke rule is that it's too well known. And when rates first went up, almost all real estate sectors got adjusted pretty quickly, except that space. So um, in our area, we saw residential single family make between an 8 to 11% adjustment within like just like about a year. And then it kind of flattened out. It's been crawling, kind of scraping along the floor since then, like 1% a year appreciation, but pretty much flat. Office space got annihilated. I have not been tracking if it's been going down further. That's not my sector, but it's still a bloody mess.
Yeah.
And maybe it's recovering, and I'm not aware of it. That's an opportunity that some people are probably recognizing that I haven't. But it was
I don't
just
think so. I don't think so.
it's still
I
pretty
don't
bad,
know.
right?
I think it's pretty bad.
Yeah, it feels like it's pretty bad.
Yeah, I'll agree.
But I also don't for the smaller office space that like you could do like an owner occupied office. I've watched that space because I originally was thinking about buying something like that, and I haven't seen that stuff come down a lot. But they also don't sell as frequently, so it's hard. And I'm looking at a very narrow
That's right.
scope,
I
right?
think they're also a little bit more desirable. It's a different market than a big office building. right?
Yeah,
Or big
because it's a
office
lot of
space.
owner occupied financing. If you're doing really well, you buy it, and
Yeah.
whatever. So, um, but in general, that was the story of small multifamily. It was propped up when all other sectors were adjusted, and so they were late to adjust. And that was about the beginning of 24 that we started seeing weakness in that space. Or for the first time, we said, okay, with rates being as high, they should be selling this high. They're trading at these, high 4, mid 5 cap rates when interest rates are at 6 and 7. And finally, they're being adjusted down so the interest rates and the cap rates were similar, and they're being sold for what they should be. But because things happen in momentums, right? So when the momentum is
Yeah.
going down in that sector, everything else kind of flattened out. It felt a lot like that was the weakest sector from the middle of last year till now. It's in the residential space the weakest sector because it started off being the strongest sector, and they needed their adjustment with interest rates like everyone else. Because even though they're a good hedge against inflation, doesn't mean that we should have been buying them on low cap rates when interest rates went up. They should have went down.
The math still has to math.
Right. And some people just they were watching the sector and it wasn't going down when it should have. So you just thought that was what it's worth and they were buying it, and then it adjusted. So some people kind of lost out some money. But on the flip side of it, now that area looks the weakest. Everyone is hedging. Interest rates are going to drop in the future. If you look at company, we've talked about this in previous shows. And so it feels like there's this is that last kind of moment where small multifamily is being pressured down. And as rates keep looking lower and more people are coming back to that sector, those assets will look more desirable. I'm not, I will take those moments to look for a good deal, but I'm still not a retail buyer. I wouldn't use that as a reason just to go buy a multifamily. I do have friends who are doing that. We just talked earlier before we got on the show about our friend Chris Stewart, Stewart Capital. He's been a guest on our show a couple of times. He is looking for value add multifamilies in that space that are being discounted, where if you just buy it, perform a push up to rents, is worth a lot more. Plus, you get that same swing of rates, making your investment better. And of course, I'm a condo developer, right? So I'm using that tactic to say, okay, if this whole sector is being pushed down, I'm going to try to handpick a specific multifamily in a sector that when you convert it to condos is worth a bunch more, because everyone's looking at it the same way, which is this should be discounted because of the higher rates, and it should be trading at a higher cap at a higher cap rate, which is a lower price. And this is something that I've done. I mean, I did this in the deal we're putting together is West Seattle and Alki, and it's for a different reason, but a similar story. I bought a lot of my assets there during COVID because the bridge went down there, and that whole sector, the whole multifamily sector there got annihilated because vacancies went up because of COVID, and they didn't have any transportation in the city of Seattle. Now it's like we're coming back to that same neighborhood, doing a deal, not because it's specific to that neighborhood, just because we know that neighborhood, but we're also recognizing that multifamily is, if it has an upside. So we're buying this really nice 4-unit multifamily. It's 2 stories with a huge garage basement. All 4 units are laid out like high-end condos. They have 2 bedrooms, 2 bathrooms, and one of them has and they all have view balconies, and one of the bedrooms and bathrooms are an ensuite. So it's a perfect set to say, like, okay, well,
walkable to the beach, like very accessible.
Yeah, very accessible to Alki Avenue, and there's lots of high-end condos on Alki Avenue that we're using for comps. And so we're going to convert that fourplex into 4 high-end condos, and we have lots of comps to support our value, but we also have some uniqueness to our project that other ones don't. All the comps are usually on Alki Avenue, which for accessibility and walkability is great, but also it has its flaws too, because like you get great views, but you also get lots of noise, because in the summertime you get people who are partying and loud cars and all that stuff.
Yeah.
Where this project it's really close to the Ave, but it's just enough behind it that it feels like you're in a neighborhood. The other thing it gives is the city of Seattle does not allow landlords to turn their rentals into a short-term rental if you're on the shoreline or within a setback close to the shoreline. Anything that's basically too close or right on the ocean or lake.
Right.
And so all the
places
comps that are
literally right behind that line.
Yes, that's correct. The line stops at the houses across the street. So those ones can be STR'd, the Socanar fourplex, and we're basically just surrounded by a bunch of houses. Yeah, there's a couple of multifamilies
Yep.
kind of nearby, but most of them are kind of run down and closer to the Ave. This one's
Yep.
like further behind, surrounded by houses, and it's in that area. So we're going to convert them to high-end short-term rentals, and it's a it's requiring me to do more work than most projects I've done, but it's actually one of the reasons why I was excited to do it is because there are we've done a lot of projects that have nice finishes. Chris, you've been to the
Yeah.
detached ADU that I built on Juanita Drive, so you've seen some of the stuff that we've done, but it's
Yep. That one
still
was super nice.
yep. And we definitely did some cool stuff in there that was unique, but most of the time there's a limit to how nice you should make something to make sure it's actually a good investment. The one on Juanita Drive was like the margins were so good it gave me room to spoil myself a little bit with some finishes, but it wasn't necessarily going to give me a return on those finishes.
Yeah.
In this case, this project actually requires it because there's condos that sell from 1.1 to 1.3 million, and there's some that sell between 7 to 8. And so we had to have a strategy to figure out like where in that range we were going to fall. And the strategy was some of those projects have certain condo amenities like a pool, workout room, elevators, concierge, a club room. We won't have any of those features, but we're replacing it with quiet neighborhood and more. And also you can Airbnb hours, which you can't do on any of the other projects. But the big part was our interior finishes will be higher end than all of the units, including the ones that sell at the top end of the range. But we're not trying to get their values. We're just trying to do that so that way an appraiser can say, okay, because our finishes are nicer than all of them, we should be on the upper end range. But because we're not going to try to like, in reality, when we actually, if we were trying to sell them, we could actually try to target the same cost per square foot as those and argue that the nicer finishes and uniqueness of amenities are worth more than their amenities. But for our purposes, we're keeping all of them. We're just telling the appraisers, we're just trying to get to the middle upper end range. And we can, and that's the strategy. They can, and having talked to and consulted with some, they thought our strategy was good. And so we're kind of targeting like a 900 to 1 million value per condo. And we're locked in buying it for about half that price. So
Yep.
it's gonna require a lot of
Um,
work. I think our rental budget's gonna be close to 700 grand combined um, for all
that's
of
what the
them when it's
common
all said and done.
areas, right? Common
And
areas
and
in
and
the,
the unit remodels for all of them combined.
yeah.
So if you actually had to do the projections, we're gonna be at like a $2.5 million total cost for all of them, like a 3.7 to 3.8 combined total value-ish range is what we're targeting. But we put together, it wasn't hard to find partners that wanted to go in it. The another fun part about it is that we've kept it in a small circle of friends. Um, the margin would have been the best if one person did the whole project, sold 3 and kept 1, but then they would have had been at the mercy of 3 strange new homeowners to control the HOA with them, which
Right.
that may not go the way they want. Where if an HOA is kind of established, there's less chance that someone's going to try to jack it up. So the 4 investors we put together were basically 4 friends who are all going to keep a unit, including, and that includes you, right?
Yep. 100%.
Yeah. So that's the project. It's not, of all the deals we put together this year, I won't say it's the highest margin deal, but some of the highest margin ones do require this new construction permitting aspect. The margin that we're making without having to build is one of the better ones. But like
Yeah.
I said, it's more than just that. There's a personal aspect to it.
Yep.
So we get to do some
And there
really
were,
high end stuff.
yeah, there were some things that have caused a little bit of a change in the numbers, right? We
Hmm.
got the inspection and there were some unanticipated structural things that are going to need to be fixed that,
Yep.
you can't always just negotiate those all the way down. Like you have
Yep.
to meet in the middle. I think that kind of, you know, messed with the numbers a little bit. Maybe why don't you, I mean, why don't you talk about that process a little bit?
Yeah.
The idea is to just, I think in a way, just talk about what's happening with the deal. We can talk about that and then we can talk about
Yeah. Every single
our unit.
deal. Yeah. Every project should have like a high level plan, and you have to be nimble enough to kind of make concessions once you start to dive into things. In this case, the concessions were, hey, there's actually some more damage to this property than we thought there was going to be. So going through the process of finding out what those were, negotiating with the seller to help pay for a good portion of them so we don't have to take them on. And so that was part of it. And then because most partnerships are a group of people who stay in a project evenly in some capacity, like limited, general partner type setups. This one is done differently in that, it's a 4 partnership that will split to 4 homeowners who all own a condo unit. So the partnership will end just, handful of months after closing with a operating agreement of how we're doing the deal. And, and as we found specific damages, not just the common areas, but some that were higher on a specific unit, we had to budget those into a split cost between all the units. So that way it was a fair deal for everyone. And then the remodel budget for each unit pushing forward was kind of set so that they're the same because all of them have the exact same floor plan.
Yeah. But in negotiating, the final, I guess, final purchase price, there was some, I don't know, not psychology, but some salesmanship that was required, right? Because this was an estate sale. The
Yep.
buyers or the sellers, were I guess motivated to sell, but also had ideas about value
Mhm.
that
I thought
were,
there was a 50-50
yeah,
chance it was going to come apart at one point. There's no question.
right.
I
Because they
knew
were
where
kind of
we.
not, they were not local for the most part. They hadn't really been to the property for the most part. So you're having to deal with someone that has an idea of what this property looks like or what it's valued at, but doesn't have a lot of like boots on the ground knowledge.
That's
And I
right.
think if they would have shown up, they may not have changed their negotiating strategy, but I think their view on where we were coming from may have changed a little bit,
And
because
they purposely were trying not to know about it so that way
that's
it
right.
would give them extra leverage. And it was a good strategy because ultimately, if they had seen it, I probably would have pushed them harder. But we were at a margin that worked, and we were trying to figure out terms that wouldn't work for everybody. And there's times where I'll see someone buy something where on the surface you just go like, "Oh my gosh, that was such a good deal." And it's not necessarily a better deal than some of the stuff that I've bought, but it's a good deal because it almost everyone could just look at the sales price and be like, "That sold for too cheap." Versus like on our base, like there's going to be a lot of multifamily who will see this thing sell at the price it sells at and say, someone really liked the property because it's unique, its location, it has views, maybe it's an owner occupant plan deal. But if you're looking at it purely on a multifamily basis, they overpaid,
Yep.
right? That's a
Yep.
common thing I will hear because like my friends that are peer multifamily investors, I've commonly heard them say, "Oh, I think you could have got that one for 5 or 10% cheaper." But what I'm looking for is so unique that it's like I could find something else that on their consideration was fair priced, and the margin on the upside is a lot less for what I do with it. And what happens is these owners own these unique multifamilies, and they can't put their finger on what they think it's going to sell for, but they just feel like they should get more than the normal multifamily owner does because they know their property has unique features that are not typical. And what they're always told is from regular multifamily brokers that people don't pay a premium for those features. And what I basically come to them is I say, I'll give you a premium. That way you'll sell it to me because historically those owners, if you keep trying to give them the same message you hear from those other brokers, my history says they very often just say, well, screw you guys. I know I have something special. I'm keeping it.
Right.
This is an estate sale. There's less chance of that happening. So we could have tried to push them a little bit harder. But I think keeping John in the deal made it a little bit of a, tougher to do that because he first came in representing them.
Yeah.
But
I think also you run the risk of you get to be the one that said, I told you so, but then they end up selling it to somebody else for the same price,
right,
you know?
you don't
Because
want to be the one to piss them off.
they wait another 3 or 4 months and then somebody else is in the deal,
Yep. Let's say we got it for exactly 100 grand less, and it gave everyone a $25,000 discount. We are projecting a cost of each owner into the unit just under 660, with an average value of about 925. Right. So at 25,000 on a 925 average value is a 2.7% improved margin. Right.
Yeah.
It's I'm not saying that's not a big deal. I'll take everything I can, and I was pushing for everything I could, right? But but there's a moment where you feel like this is as far as I'm going to get with this particular negotiation, and do I want to risk the whole deal to try to get it to what the fair market says when I know that I can make money at this price
Right.
and the
There's
uniqueness
still
of the
room.
deal? There's still room.
Yeah.
There's still room. So we're targeting a 925 average value per unit. I think I kind of mentioned it earlier. We are using a traditional bracketing method for how we're coming up with our value, which is a very safe approach. But there's an argument to say that when it actually comes time that any of us want to sell our units, and if someone does a good enough job trying to properly market what these units are, they very easily could end up getting the top end range of the values, not the middle upper. And so
Yep.
it's possible that we are actually hitting $1 million plus each. That project that is comping at the high end range, the cheapest 2 bedroom they have is 1.1 million, and the view is worse than ours. All the ones they do have several that are way better, but they all sell for like 1, 2, and higher.
Yep.
And our finishes are clearly nicer than theirs, but no elevator, no gym, no
Right.
pool. And we're in
Yeah.
Seattle. How often are you can use a freaking pool? You're right next to the beach. But still, there's some value to that stuff. And I think
Well,
that
yeah.
over time, we might
Yeah.
add some of those amenities. We might add a sauna and a hot tub. No, we don't have room for a pool, but we'll probably add like a community hot tub and sauna eventually.
Yeah. I'm on the fence about that, by the way.
Are you?
It's just not sanitary. Like
But
if
that's
we were,
technically I mean, as long as it's being ran and operated the same as like how the other communities run, it's the same story.
yeah, you're right. But if just the I guess the short-term rental aspect of it is what makes me um more hesitant. I just feel like there's more room for people to be stupid in things like that. And just, you know, I haven't thought through though at all. That was just my initial thought, honestly. But I'm sure it happened. I'm sure they exist other places, but you just have to keep it clean, I guess, and stuff like that, which is it's this, I guess it's the same problem, even if you just have a hot tub at your house, like a single
Yeah.
family
And that
Airbnb.
is a common, yeah. My answer to that is that it's like how common is it and how liability is protected in those. And that
Yeah.
the answer to that question is within the SCR community, because it is the number one, it's one of the top amenities that boost your short-term rental income by
Yeah.
professional hosts. And so as long as we're operating and treating it the way it should be, then I think it should be fine.
If we could find some way to prop it up where it has a view, that would be bomb.
I don't know.
I don't know if there's a spot for it, but that would be cool.
It would be somewhere in that, that balcony, that the porch that is on the garage level.
Yeah.
It would be building that out, you
Yeah.
know,
Yeah.
around that corner.
Mm-hmm. Yep.
So,
Be cool if we could find some spot though where you can sort of still see, you know.
mhm.
I haven't even walked, I've only been there once. I wasn't even thinking about that at the time. But yeah. So that's
Yeah.
cool. That's fun. And then all right. So anything more on just the deal sort of structure in general? Next
No,
step
I mean
is
it's a traditional condo conversion. People might
yep.
have lots of questions associated with that kind of stuff, but those are very, very state specific legal type things and processes, which if you really want to get into all that stuff, you really should just be a client of mine. But
Yep.
it just points on the high level of when people say when people are scared, you should be excited. When people are excited, you should be scared. It doesn't just mean you go buy into a scared market. Um, I was talking to a good friend of mine. His name is Bill, and he's always wanted to get into real estate, but he always hates how the community always talks about everything as unique and it's not like SOPs can't be standardized. And I was thinking about it, and I told him yesterday. I said something to him that finally, when I said it out loud, and I could tell it kind of clicked for him for the first time too. Is that even Goldman Sachs, when they make a bunch of money doing M&A deals, when rates drop, they are like the system is you have to have a company designed to have a good deal maker who knows how to recognize value. And so what he was referencing that isn't so like sucks is like how can you make an SOP that people could just make a process? It's like, well, the SOP for deal making is you have to be a Goldman Sachs so that you can have smart, educated Harvard grads be deal makers under your firm. And each one of them, there's a very long process of teaching them how to do those M&A deals. And I said, look, what's happening in these real estate deals is someone's learning how to be a deal maker on a specific asset class, and creating an SOP for that person when it's such a specialized sector is really just meant for their personal business. But there can be an SOP process for how it's managed for maximum cash flow pushing forward, right?
Yeah.
And I think this property is a good example of that. Like, like I wish that there was an easy way to tell people how to be a good condo developer, but the truth is you probably should be a client of mine, rip through a dozen deals, and you'll probably be good enough to start trying to find them on your own after that. That's not an SOP process, right?
Right.
But how you manage it as either a traditional, a midterm, short-term rental, or a blend of or hybrid of those can be an SOP that's standardized operations that ongoing, you don't have to spend a lot of time on to. And I think that's a lot of how a lot of businesses end up going. You can have a procedure and process for how you're going to make the business profitable, and that should exist in all standardized procedures. But there's always going to be a little bit of a industry expert special sauce aspect to deal making, and you're either good at it or you're not. And you can't teach other people to do it, but it's that's the world of real estate, right?
Yeah.
The best deals happen that way. You have to be okay um, with being part of it being kind of a uniqueness. And there's deals that don't require that. You just don't make as much money on them. That's just how they work.
Yeah.
The ones you make the most money on, there's a deal maker who's recognizing value, right? It reminds me a lot like Berkshire buying into like Occidental Petroleum. They keep buying into that stock, and then I'm looking at the numbers, and I don't really get what they're doing. They have a plan.
Sure.
They have a plan, and as they own more shares, they have more voting rights, and there's something happening within that space that they know of that the outside people can't really see. And so you either just believe in the leadership enough to know that one day it's going to pay off, or don't touch it. Which for me, even though I'm a big Berkshire fan, I just don't touch it.
Yeah. Yeah.
So
That's cool. All right. So let's see. So we got the deal. It's pending basically, right?
yep.
I guess everybody has to get all there. We're getting the LLCs together, operating agreement for everybody, which, if you're just listening to this, I would encourage everybody to, if you're doing a deal with anybody, make it legitimate. Like you don't have to spend tons and tons and tons of money on an operating agreement and things like that, but you should put something together that's formal that just outlines what everybody's doing. So
Yep.
it's just clear
A
and
couple of
easy.
good just standard practices. So some people say, oh, I want to do deals with people good enough that you don't have to put things on paper. And some other people say everything needs to be on paper to protect yourself. And I think here's a problem with those two recommendations. If you do a deal with someone that you can just trust, you feel like you don't have to put it on paper, or you might feel like if you put it on paper, it allows you to do deals with people that you don't know if you trust enough. And in my opinion, the fact that you can trust them not being on paper means that they're a good partner, but you still need to put it on paper so that expectations are clear and there's no misunderstandings. Because even if everyone trusts each other, the assumption that it's going to work also leads to other assumptions, like what's going to happen next, or confusion. And if there's lots of moving parts, it's easy for people to remember things incorrectly, and actually what could cause like a rift within the partnership and people that you do trust personally because of unexpected changes or expectations that from everyone. So it's good to get it out, get it written. I think that you should have people that you trust wholeheartedly if you're going to do a deal, and then you should also put it on paper so that way everyone's really clear. I don't think that you should be using clearly outlined, highly protective operating agreements as a method to invest in people you don't necessarily trust. And I don't think that that lack of operating agreement just because you trust someone is necessary either. Maybe one exception
Yes.
to that rule, of course, is just your spouse, but you just have to make sure you're crystal clear about expectations. It just doesn't have
Right.
to be in writing, but it's like, um, but I personally feel like you should just have both from my experience. And I've had lots of partner experiences that were good and bad. And my first recommendation is try to do it on your own. And there should be a really clear, there needs to be a crystal clear black and white reason why you're not doing the deal by yourself. And I think that talking about this one kind of outlines it. There's more money to be made if I told John to buy this by himself. Because that's where this whole thing started from. He was a listing agent. He said, hey, is this getting cheap enough? I should buy it myself. If he bought it and did this whole thing by himself, he would have made more money than doing it in a four-way partnership. But it would have resulted in him being a sole owner of one of four units with three homeowners who he doesn't know, who could yank his leash and change the way they're managing it, which might insinuate him just to sell all of them, which even though he'd make money, kind of defeats the purpose of what he was hoping to get out of it. And so he'd make a bunch of money, but not the way he wants to, more taxable short-term income versus having a long-term rental that gives him tax shelters and he can hold on to it. And it just doesn't pencil great for someone who's going to try to keep more of them because the city doesn't let more than one person have an STR license. So having one person own all four with the same plan, they could only legally short-term rent one of them. And so it just didn't, it wasn't, it was a financial, for someone who just wants to make up, like, let's say someone just all they care about is short-term return and they don't care paying the taxes, then I think you could just try to flip the whole thing.
Yeah.
But for someone who wants to hold on to something long-term and get some tax shelters, it made sense to do it the way we did it. And that's actually how the deal came together is like he and I were talking through whether or not you can make the deal pencil for him. And the last thing I said to him in passing was, with all the issues I just outlined, it would be really cool if just four friends bought it with the same goals and just kept one as a short-term rental. And then that night, I just kept on thinking about how I ended that conversation. Called the next morning, like, hey, that last thing I said, we should just literally do that. Let's call around and see if there's some other people, right? Tom had just finished getting pre-approved with me to go look for a deal for him, right? And so that's my
Yep.
the idea of asking you and him. And we also asked Andrew early on. There, you guys were the three we asked early on. Andrew shortly after said he probably wasn't in the best position to do it. You guys said yes, but I had a lineup of people who wanted to jump into it.
Yeah.
But luckily it stayed all within our poker game.
Yep.
And the deal came together. And my brother wanted me to, we had tried to do a Kirkland deal that didn't pan out because the county gave me some misinformation on a deal way back in the day, and we jointly took about a $60,000 loss on it. And he's like, and he's been waiting for me to find him something in this market, which I found a lot of good deals, but I told him if I did find something for us, it'd be a no-brainer. And doing this one, it felt like the no-brainer we're talking about. So
yeah, that's awesome. Yep.
Yeah.
So, okay. And then the only other thing that's really happened so far that I think is just a fun story to tell is how we resolved our unit choice issues.
Yeah. So when I first put myself in the deal, I was kind of just like, look, I want to make sure everyone's happy. I'll just take whatever unit. Then my wife was like, no, like this is happening because of us. Like, it was your idea. John is taking what I think is probably for location wise the most desirable unit, but also is occupied by the most pain in the ass guest tenant.
Right. Has the biggest problem potentially.
Yes. Right.
Longish term problem to resolve.
Right. It can be resolved. He just moves into it for a hot minute and then moves back out, but that's a topic of a different discussion.
Yeah.
Mine, we chose the other upper floor unit. Tenant lease expires in a couple of months. And we might take the same approach with the same city's rules about like occupancy. We might do some remodeling on our house, which means we might need a different place to stay at for a little bit. So we might use that reason to move them out. But you and Tom both were allocated to take one of the lower floor units. And after both of you walked it, both of you wanted the same unit. and there were some things that we could use to negotiate the terms. We had 7 parking spaces out of 8 units, so one was supposed to get only 1 parking spot, the other one got 2. And both of you said the same thing. I'll take this one I prefer, but I'm willing to forfeit the parking space for it. So you both came to the same conclusion, and then we just
Right.
said, okay, if that's if both of you still have agree to terms of how you would trade out of that to get the unit you prefer, but you still land with the same preference. No one's willing to give up on the one they wanted. Then it was like a coin flip. So we basically just agreed to some cash in a parking space for who gets which unit. And if both of you still prefer the same unit, then we just flipped a coin. So I
Right.
flipped a coin, and Tom called it, and he called it to your
Yep.
favor, right? He called
Yeah.
heads, and I flipped the tails.
Yep.
So no one visually saw the flip, but I
No, right.
did
We
it.
did it over the phone too.
We did it over the phone, but I did it very 50-yard line like. I took it, I just flipped in the air and let it land on the ground, and it
Yeah.
landed tails. So
Well, you don't care who wins. I mean, it's
nope.
not like it was a big contentious deal. You just needed
What
to
I cared
be
about was is that it
involved.
wasn't going to be a big enough deal that people were going to make a big stick about it, and both of you were cool about it. Both of you were okay
Yeah.
with it going either way, but both
Yeah.
of you had your preference.
Right.
But no one was going to make a big stick out of it, which is it's just a really great example of why it's better that it wasn't purely just money partners, because someone could, that negotiation could have really hindered things for a while if
Agreed.
people got really sticky about it.
Yes. It could have taken a long time and been a huge pain in the ass,
Yeah,
potentially.
yeah,
But, it's nice that both of the units are actually good. There's the one difference is, I think, visually, because like when you line them up and appraise them, they're probably going to be very, very close in value. Very, very,
mm,
they may even be the same. But just visually, the one has a little bit better light, like when you're on the deck. That's the only difference, you know.
mm.
I think, and so I think
Yeah.
that's what
I
made
don't
that one
remember that
appealing for both of
difference.
us.
I just assumed it was a view thing.
It is kind of, but I think also, and we talked about this. I think part of that is just that on that other side, there's a lot of overgrowth with
Mm,
vegetation and stuff like that. And I think once that gets handled, I think that one also will open up a lot more from a just like a light perspective, because it's just the one unit opens up to the street. So it's just there's nothing blocking you,
right.
at all. And the other side just has there's tree. There's not a house there, but there's just some trees and there's just been growing and not been well taken care of.
I see.
The landscaping around it. I think that made the biggest difference. That's also where the I guess the greatest individual unit damage is, right? Although that's not
Yeah.
that big of a deal because as you talked about, we're all going to sort of like roll that into the common area cost.
Okay.
But yeah, it was something that I was happy to get done with just so that we can move on to the next stage,
Yep.
because this had been lingering for a little while,
It was lingering
you
for a
know.
little while,
Yes, not in a
and
bad way, but it's just kind of like, well, we don't have to decide yet, the deal, we're not in the deal, we're not all the way done yet, And then it's like, well,
yeah.
okay, here we are. It's
Yep.
time.
And there was a bigger fish to fry. I was like, look, we could talk about that, but we need to get this whole negotiation with the seller handled. We
Yeah,
need to
definitely.
make sure it's a sound deal, that the numbers pencil. And I had to sharpen my pencil quite a bit to make sure um, you know, that we can hit the budgets that we want to on the remodel. But it comes with it too, right? That was always going to be a thing I was going to do, and and so here we are, So made some concessions on common area remodels, made some concessions on finishes, but we should, the it the units should still pretty much look the way that we pictured it. Um,
Yeah.
Diane and I were actually working on some of the specking out the stuff last night. So I found a quartzite that looks a lot like the Taj Mahal stone, and there's gonna be really cool stuff. I'm really excited. I'm really excited to put this together. And so
Yeah, it's gonna be fun.
yeah.
Cool. All right, what else? Anything else we need to talk about or
Um,
want to talk about?
you know, just the market in general, I'm starting to everyone was so bullish on AI, and we've had this pretty much volatile but relatively profitable year in the stock market. I mean, I don't know how
Yeah,
other people invested, but I had a great year.
I did too.
Um, um, you know, was touching at 40%. And it settled down a little bit, but we're still way over 35 at this moment. But it's starting to feel a little bit like it's like people were taking money off the table a little bit, and time for some reallocations. And I'm really excited to kind of get Andrew and Chris back on the show so we can talk a little bit about what to expect in 2026. I know that in 2026, there's already been a hedge that lower interest rates will be better. And I've talked a little bit about like some examples where I think that there's some opportunities. But those opportunities are going to be like if you're hoping for a 10, 12% return, you can probably get that a little bit more than that in a fraction of the year with a couple of these investments, which then you would have to figure out how to like carry that on for the rest of the year for a lot higher numbers. If all the things I'm predicting come true, I still don't predict I'm going to make the same kind of return next year as I did this year.
Right.
Um,
Like maybe like more doubles out there than home runs.
yeah, yeah. I mean, my average price of what I acquired Google at is bouncing between 95 to 100%. Our average share price was right around like 160-ish.
Yeah.
And so it's a couple of times it's touched that 320 a share. I think today it's trading slightly lower than that. So we've been operating on a 95 to 100% return from, then, and then, a handful of other companies that we made between 15 to 30% on. But for a blended return of just, like I said, just under 40%. And, and I'm very happy with those numbers. And I think that, if I were to get half of that next year, I think I'd be pretty happy with that. But there is this kind of feeling like, okay, after such a great year, what kind of runway do I have? The rest of Wall Street's starting to make decisions about Google. We talked about that. And so people are starting to extend out the runway where they think that share price will go. But from what all those projections and that everyone's kind of putting on the street, we're probably not expecting more than 15, 20% out of that share, based on what people on Wall Street are putting. They're putting a target price that that their valuations are having it close to like around 400 a share. And so at 320 a share, it's gonna, it's not going to necessarily do as well as buying into Google in April of 2025.
Yeah.
But it falls in that space of like I said, if next year I end up having a blended return of between 15 to 25%, which is still really good. I mean, it's outperforming S&P historical, right? Then, I don't see how I'm going to be able to replicate what I did this year. I think this year, kind of like 2020, was an anomaly of like there's an aggressive dip and an aggressive bounce, and if you knew what you're doing, you can make a really good return. And yeah, and that's on a broader scale. I had also had a great year the year that we had that conversation about Meta, which I think was in 22. But that was like a, similar to Google, that was a kind of like a one-off.
Yes.
But if you also looked at when I started talking with Google back in April, even though not every company has held their 52-week high afterwards, you could have just dumped a bunch of money into the Mag 7 in April of 25 and crushed it. Everything was down then. And what's funny is that even though I think Google has more runway with the fundamentals in place, I want to say that of the Mag 7, the one that you actually would have made the biggest return on was probably Tesla. And it wasn't because of fundamentals. It had more to do with there was too much pressure on the stock because of how many Democrats were blowing up random people's Teslas on the street that people were afraid to own them. Remember when that was kind of happening?
Yeah. I do.
I think that might have actually given people a better return, although that was a lot riskier endeavor, in my opinion.
Yeah.
I think it depends on people's point of view. Some people thought Google was a risky endeavor at that time. They thought ChatGPT owned their lunch and they're going to lose all their search engine business. I wasn't a believer in that, but if you're believing in that narrative, some people could have thought it was more risky. But I personally felt like Tesla was more risky because they're being evaluated on a much higher PE ratio. And you're pretty, I mean, let's face it, when you invest in Tesla, you're investing in one person. like it's scary to think about like where Berkshire will be in 50 years after Warren's gone. But they spent
Yeah.
a lot of time with a lot of high level people who've done a lot for that company to take over the reins.
Yeah.
And
I,
it's
yeah. I
it,
think
it
also
may
with
not be the same
Tesla,
company as it was, but it's believable to think that the people they're putting in place could achieve 65 to 80% the same as when Warren and Charlie were there, because they're only
yeah,
making bigger level decisions and really safe investments, so forth. Versus like, does anyone like what would Tesla be worth if Elon wasn't there?
right. Well, I think if you're investing in Tesla just for Elon, you're also not making a very good choice. I think the reason that I would invest in Tesla is for what's going to happen in the future that you can't yet identify, because the way that they uh, you know, take in data, what they're going to do with that data, how they're going to roll out, like, who knows, self-driving cars in the future, like as in like taxis and things like that. Like, it's going to be, I think, those types of things. Elon is the reason for those things, right? It's like this vision that he has for what this company will become. But I think if you're just buying it because they make good cars, eh, you
Well,
know,
I do think that you do. I do think, studying what, you know, what Warren has always said is like criteria for investing in a company, the quality of the leadership is a very important part of the decision making. But I
sure,
think I think it's emphatically higher for that company than others, because even if another company said, like let's say Meta, for instance, said that they wanted to get into the spaces that Elon's in, and look, there's some smart tech people there, and Zuckerberg's done a good job. But I think that they're playing in their space. They're working in where their strengths are. They're a social media leader. They're the
sure.
leader in augmented and VR headsets, and they're pushing for glass wearables, and they're ahead of everyone else in that space. And I don't see that anyone, we see people trying to invade into their space, but if they said they wanted to get into the spaces, because everyone is investing in AI at some capacity, but if you actually look at what Elon is trying to do, if you said name another CEO that you think can pull all those things off at the same time, he's the only one qualified to try.
For
Um,
sure, for sure. I'm just saying you don't necessarily know though what the company is going to become. I could see it personally doing something like Amazon did, okay, where you see them as this, they're a retail sort of online retailer, they're selling books, they're doing things like this. Then all of a sudden you're like, "Oh, they're doing all of this like the
AWS.
Amazon services, right?" Where you're
Mhm.
like, "Oh, this is completely different." And then you're like, "Oh, now they have this huge shipping, you know, uh logistics. They're basically a logistics company." Like, you never could have seen that happening. You could see Jeff Bezos though, I think, doing that over time. You could see that he had a bigger vision than just being like the Walmart of the internet, in a
Right,
way. And I
right.
think the Tesla is the same way. I think that's why it's not a terrible idea to invest in them, but I would think it would be for like a longer term thing. Then they're going to come out with some new car
Th-
and
There's
blow
a
up.
difference between them, though. Elon verbalizes his plans way before he's going to do it.
Yes.
So he does actually tell people, and you either at first sometimes he shocks you so much that you have a hard time thinking like, when I hear him make his predictions, my first reaction to it a lot of times is like, how in the hell do you think you're going to be able to pull that off?
Right.
But then the longer you watch him and you see him actually start to pull that stuff off, you realize like, okay, maybe I do believe he can pull it off. Um,
Yeah.
but
All you need
the,
to do is see one of those rockets land in the middle of the ocean, you know? And you're
I mean,
like,
at this point, I think
"What?"
that they've talked about like his space program. He was working in conjunction with NASA and then eventually went private because there's a moment where it felt like he was, if anything, they were becoming more of a hindrance than a help.
Yeah.
And then he's just like, screw it, I'm just going to do it on my own. And Jeff Bezos actually was trying to compete with him in the same private sector with Blue Origin, and it feels like they're not even close at
No.
this point.
No. But Bezos doesn't have I don't think, the technical chops that Elon has, you
Hmm.
know? Like,
Yep.
I feel like Elon, I don't know if he could, but I feel like he understands how to actually build a rocket. you know,
I mean,
like,
he's been on the All In podcast publicly saying, and like he hinted to it in multiple occasions, but he said it very clearly. Bill Gates isn't strong in the sciences, and it's
yeah,
like I would actually trust Bill more than I would trust Zuckerberg in the sciences. And what Elon's saying is like, look, at the end of the day, Bill's criticizing him, saying you can't make an electric semi truck; it's not going to have the range you're hoping for. And Elon's like, well, tell me what part of the math I'm doing that says it can't happen. And Bill couldn't answer the question. He could
right.
even reference why he made that comment. And his reaction is just like it to make that comment and not be able to have, like there must be like, is it this factor? Is it this variable that you're thinking that it's incorrect? And what that really points to is the fact that when he says he thinks he could do something, he doesn't do it in the normal, let's just try and we'll figure it out, Richard Branson CEO way. He never will make that statement until he already sees a path on how he's going to do it.
Yeah.
And now he's just working on that path. And that's what makes him so unique in that space. He's a little bit more like Howard Hughes
Yeah.
than he is like Richard Branson. And that's what makes him so different. And so, when I look at Tesla, it's really clear. Like, first off, and even Charlie Munger said this before he passed, even though they never been an investor in Tesla, they recognize that he, in a world where there's more consolidations and closings of car manufacturers, he made a major player in a space where it felt like there wasn't room for more competitors, if that made sense. The
Yeah.
Koreans did that by starting at the bottom level and it's slowly creeping into the Japanese space. And they kind of did that with all consumer electronics. Samsung did that with Sony. Kia and Hyundai did that to Toyota and Honda, right? So it was kind of a similar philosophy where Tesla's approach was completely different. No one has done it, and it's going to work. And it didn't just work; it worked amazingly well. Um, and that's a really hard space to have done that. And so, it it obviously makes sense that the next place he would go into is to compete with Google and Waymo with robo taxis. But he's really focused a lot in the future on robotics. But it's funny because if you actually hear him talk about it, he actually talks about how AI and tech is going to solve the GDP problem that the US has. It's our best chance to, with our budget being such a mess. And that if it does, what he describes as the outcome actually sounds semi-socialistic. Have you ever listened to him talk about this?
A little bit. A little
He
bit.
picked,
It sounds
he talks about how
socialistic, but
everyone would have kind of like a fixed, higher type of income. Quality of life will be massively improved for every person. Every person's
mhm.
going to have robots doing a lot of the hard labor for them, right?
Yep.
Personal robots will do a lot of the stuff for people, right? And then people will have, and then, one of his defenses against like AI potentially being something that's destructive to the human race is the fact that he wants us to use the same tech to enhance what we can do, basically, brain implanted microchips,
Yeah.
right? Um,
Yeah. The way I've heard him, I think he was the one that was talking about this, but the way, maybe it may have been like he was on Joe Rogan, I think,
he was on the
recently
Joe
about
Rogan
it.
podcast and he was recently on All In.
Yeah. So it was probably it was definitely probably on one of those two spots. But the way that he was describing it, where I was like, oh, that makes sense. And it sounds kind of socialist, but I just think he was not doing a great job of explaining it. But he was describing just this state of abundance that's gonna happen as AI takes over, which means we're not gonna have there will no longer be a shortage of food because we will just solve that problem. So food costs will basically drop to zero. Like you won't
hmm
need money because there will just be so much of this thing. Like, you won't need fill in the blank. You won't need healthcare, right? Will become so cheap because it will just be solved
And
essentially.
technically, we're already seeing versions of that, right? People might say that sounds really like, hokey pokey. That who knows it looks like. But if you took a if you took a iPhone Pro Max 16 and just to uh, went back to the 80s and had the crowd coming out of Back to the Future 2
Yeah.
and said, "Hey, I hate to tell you, hovercraft skateboards are not the tech that you thought was going to change the world by this age, but let me hand you this.
Right.
You're no
Yeah.
longer going to have phones. You're no longer going to spend most of your media streaming on TV or radio. That
Well,
this
it's not
little
even,
tiny,
think about it like this though, when it comes to abundance, there are no longer any gatekeepers from education, from understanding, from learning, from being curious because of this. It's all here. You can literally find anything that you want and it's in your hand,
yep.
you know?
And we're discounting because it's kind of like it's boiling the frog. Here's the tech, make it better, keep adding to it. Showing someone from the 80s an iPhone in the first 5 to 10 years after it was released, and then showing it to them today with an AI chat large language model bot on it is a completely different machine.
Totally.
This
Yeah.
this machine, although the functionality and the look of it looks somewhat similar, if you were to give someone a demo of what you could do with this, if an alien came to space and we were describing what this device could do, and it included you talking in chat mode to Gemini or ChatGPT 5.0, right? People will be like, "You mean to tell me that the Star Trek tech is available to you, except for it's not going to make food on the whim, but it'll just tell you
Right.
anything you want, and you're talking to it like it's a person, is real tech?" And the answer is yes.
Right.
On top
Totally.
of, if I want to order food, I could just push a button and it shows up at my house. If I want to order groceries, I just go to push some buttons and it shows up at my house. And these are, like, there's it it takes time for people. Like, we adopt the technology in chapters, and
Right.
at one point we just make it like a normal thing for us, but it doesn't.
Totally.
It
Well,
um
yeah, you see this everywhere. Like, think about the internet. You used to have to pay quite a bit to get to internet. Now it's basically everywhere. Long distance phone calls. You used to have to pay by the minute, but as things get sort of more ubiquitous, they just become cheaper and in a way almost free.
yep.
I mean, you can call wherever you want in the world right now if you have an internet connection for the cost of the internet connection, which is
Hmm.
almost nothing. And can be nothing if you go to Starbucks. You can use their internet for free, you know? So interesting stuff. Okay, let's wrap it up. We've been going for a while. That was fun.
Yeah.
Good talks. All right, so we'll keep everybody updated on the progress of the project. And maybe we'll have some more guests on here on a more regular basis. Keith can
Yeah.
go talk them into it. So that is it for today. This is the Business Barbershop Podcast. I am Chris.
I'm keen.
That's a wrap. See ya.
See you guys later.